The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So it's Friday and we're going to be talking about money, and I've got so much to cover today. We don't have time for a guest. We're going to do this straight through. I've got so much to talk about and on such different subjects. I want to start talking about a study done by R.W. Baird. It was done maybe 4 or 5 years ago, but they looked at some 4,000 mutual funds, and they looked at the funds and how they performed. And they looked at the 10-year time period that they wanted to have a long time period so that it wasn't a random thing. It was something where you could look at how a fund performed. And they wanted to see how many funds had actually done better than their benchmark by at least 1% per year on the average over those 10 years. And out of over 4,000 funds, they found 370 that actually did that. If you took those funds and you took the beginning value and the ending value, and you looked at the compounded rate of growth, that over 10 years, those 370 funds produced at least 1% per year on the average better than the benchmark. But they wanted to look at it because it wasn't a time in which each of those funds did 1% better each year and every year, or 2% better year after year after year. They wanted to look at it and what happened during those 10 years. I know of only one person who claimed that he beat the market year after year after year, and he's in jail. Bernie Madoff. He claimed that he beat the market every year. He only had one down quarter over how many years, 15 or 20 years, how many it was. No, they wanted to look at these funds and see these were actual and real and see how they did. And they found that 100% of the 370 funds, 370 out of 370, underperformed at least 1 year. 100%. 85% of those funds underperformed for a period of at least 3 years. And over 50% underperformed 5 years. Think about that. 5 years, half the time they didn't do as well as the market, but the other times they made up for it. Not only that, 25%, 1/4 of those funds, over 90 of the 370 funds underperformed the market by over 5% in at least 1 year. Actually, for a period of 3 years, over 5%. Think about that. Out of 10 years, for 3 of those years, 1/4 of those funds, 90 of those funds, did worse than the market by over 5%. That was a study, and those were the best performing funds, the best 370 out of 4,000. Less than 1 out of 10 were able to do that. You know, and the reason I bring this up is because 2016 is not looking like a great year for my clients. It looks like 2016 is going to be a year in which we underperform the market. I've had those times before. 2007 was a dramatic underperformance. But you know, 2008 came along, we did better than 2008, although we were down. 2009 came along, we had a great 2009. By 2010, early 2010, my clients were seeing their accounts at new highs. You know, a lot of people saw their accounts recover by 2011 or 12 or 13, but my clients saw it happen by 2010. And if you look at my track record, which is now almost 11 years long, you'll see that during a lot of those times, I've outperformed the market. And if you look at the total, we've done better than the market. And that's after all fees have been deducted. That's a net of how my clients have done. And it makes me think, but during these times when things are not going so well, I think about it's a time of buy low, sell high. These are one of those buy low times. But I think about my clients and I think about what they really, really want. And I've talked to my clients about what they really want. And, they're not interested in a computer printout on a financial plan. They really want to know over the longer term whether they're going to have the money to fund college educations, whether they're going to have the money to retire, whether they're going to be able to retire with enough money to continue their lifestyle. Not by saving 10%, because we don't save 10%. We save less than that. If you look at defined benefit programs, the kind of pension programs that our parents had going way back, companies were only setting aside 4%, and that gave a very, very good retirement. Today, with asset allocation and all the sophistication we've grown to, now the talk is you need to save 10% to have enough for retirement. If you've listened to my program often enough, you know that I think that some of that's inherent in the way we're doing financial planning, and I don't believe it has to be done that way. But so be it. Many people are saving up to 10%. Or getting a company match of part of that and putting in the difference. To me, that's very sad. I don't think that has to happen. But my clients, as I think about my clients, they want to know that they're going to have enough money to retire on and without taking a big change in their lifestyle, maybe even doing more. They want to reduce the risk, and you can't disregard 2008, 2009. It was a very difficult time. It was a difficult time for clients. It was a difficult time for financial advisors. You want to reduce the risk, and yet you don't want to be at a point where you're completely out of the market, because then you need to save a lot more than 10%. Those are the times. Those are the black swan times. And there's good times and there's bad times. And those are the times when you really think about, do we have enough to get through? But today is one of those times for which I think about my clients and think about them as some of my clients are retired. Are they going to have enough money to continue their lifestyle? I also believe that my clients want more than lower risk and higher returns. For many of my clients, they hope for wealth. They've often worked hard. They've worked very hard for their investment dollars. And whether they owned their own company, whether they had a company that they worked for and they put away money, or whether they inherited wealth, they want to have and see that it's more than just higher returns and lower risk. They want to really see building wealth. If they want that, they also want not to think about poverty. Many of my clients have come through poverty. I grew up in a very poor town. I grew up in Bend, Oregon. We were very poor. We went through bankruptcies. We went through a number of things. I know what it's like to be poor. I know what poverty is like. And many of my clients know that as well. They do not want to go back into poverty. 2008, 2009 was one of those times in which they did get scared. When you see the market down, they get scared. They've experienced it. They don't want to go through that again. Along with that, most of my clients want to win. I'm a seriously, intensely competitive individual. And I believe that most of my clients are too. They started their own business, or they climbed the corporate ladder, or in some ways they're competitive. They want to win. They do not like mediocrity. They don't want to be average. They don't want to just get along. They really want to win. And they know that in winning, it's not winning time after time after time. A baseball team, if it wins 2 out of 3 games every time, they make it to the World Series. We just saw the Chicago Cubs, 1908. You know, they only win 2 out of 3 games, and that's where they end up. My clients understand. We're going to have some down times. We're going to have some up times. The up times have to outweigh the down times. And I believe my clients really want to beat the market. That's part of the competitiveness. That's part of wanting to win. You have a gauge to measure against. I mentioned R.W. Beard in that 10-year time period. You know, they want to know they're there, not every year, but over a long period of time. They want to know that they're going to win. They're going to beat the market. Look at my documents that I signed with regulators. It includes a phrase in there that we strive to beat the market. We strive to win. I believe my clients really want that. And why? Because they don't want poverty and because they want to build wealth and maintain wealth. We're coming to a commercial break. Don't go away. We've got more to talk about. We've got so much to talk about today. Don't go away. I'll be right back after this break.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So I've been talking about my clients and what my clients really want. And part of that is I'm very intensely competitive, and a lot of my clients tend to be competitive too. They want to win. They've worked hard for their money. They want to see it grow. They don't want mediocre. They don't want average. They want to see something better than average. I started my career at Payne Weber and then Dane Bosworth and then Everin, which became First Union, which was bought by Wachovia, which eventually became Wells Fargo. I started my career, and I left when it was Wachovia before it became Wells Fargo. But when I started my career and when I began to really manage money on a fee basis rather than commission basis, when I began to do that, there was all this publicity or not publicity or marketing materials that came down from the main office. Sell the relationship and not the performance. Sell the relationship. Make people like you. Make them want to stay with you. Make them like you so much that they don't really care if they lose money, or they really don't care if they're only doing mediocre or even worse than mediocre. You know, it reminds me of a cartoon I saw. Back in 1987, there were a lot of cartoons about stockbrokers. And there was a cartoon, if you can picture this, there's a couple sitting on one side of the desk, and there's the stockbroker sitting on the other side of the desk. And the stockbroker is saying, and the financial advisor is saying, well, you lost $50,000 and I made $50,000 in commission, so I guess we're even. You know, that's selling the relationship. That's not in the best interest of the client. And of course, right now, with what the Department of Labor is doing, and the Securities and Exchange Commission is coming out with a fiduciary rule, that's the whole thing. Is the focus needs to be on the client and making the client best decision for the client, in the client's best interest, not in the firm's best interest. In my opinion, that goes all the way down to winning and not being mediocre, not being average, not selling the relationship, but really selling how the performance is. 1% over 25 years will reduce a nest egg by 17%, 2% by over 30%. Think about it. You can have almost 50% more if your returns increase by 2%. And if you've listened to this program, I've talked about 10 is the new 4. Because through asset allocation, when you average stock returns and bond returns and cash returns and commodity returns and gold returns, you don't come up with a very high number. Research Associates just produced an article in which they said for 401ks, don't expect very good results. Not even 5% a year, 4%, 3%, maybe even flat years. I believe that's really wrong. I believe part of that is the whole juxtaposition and the whole positioning of asset allocation, which we've come to believe in. And that has reduced. Mathematically, it's all simple math. If you take something that's 9% and put it with something that's 5 and something that's 1, the total return is going to be 5%, not 9%, and you're giving up 4%. What does that mean? It means at the end of time, in the end of 20 or 25 years, you have less than half of what you would have had if you would have had at 9% return. And it's even worse than that. It's about 2/3 less. So you have only 1/3 of what you would have had. That, to me, makes a huge difference. And it's a very small difference year to year. Year to year, you really don't see it. And the converse, most people have an aversion to losses. They would prefer not to lose money rather than to average out their gains. And so the idea of asset allocation was you can reduce your losses by diversifying your portfolio so that when one thing goes down, something else goes up. That was the whole idea of asset allocation. Did it work? We saw in 2008, 2009, no, it does not prevent the losses. And not only that, all it does is reduces the return over long term. It sounds good, and in theory, it sounds wonderful. In practice, simple math tells you it doesn't work. Not unless you have more than enough money, not unless you have so much money you don't know what you want to do with it all. That's not the type of client that I have. Most of my clients have worked hard for their money. They want to see a win. They don't want average. They want something better than that. And they want to avoid regrets over losses. And I do have losses. About half the stocks in my portfolio turn out to be losses. So the other half have to make up not only for the losses, but for the returns as well. And that's part of the process of selecting and knowing what I select. My clients usually want to leave a legacy for their children. And if they don't want it, I want it for them because we're living longer. For a person turning 65 this year, their expected life expectancy is going to be 3 months longer than the person who turned 65 last year. And that person's 3 months longer than the person who turned 65 the year before. And that person is 3 months longer than the year before. We're growing older. There was a time when there was a program called Queen for a Day, not that long ago, in the 50s. Queen for a Day. And when someone turned 100 years old, it was national publicity on that program. They used to put up the name. They used to have a segment of the program for someone that turned 100 years old. Think about that. Today, those type of programs don't exist because the fastest growing demographic in the U.S. are the people that are over 100 years of age. So I want my clients not to have to worry that they're going to run out of money, but to know that their portfolios are keeping track and moving along. And so it doesn't matter, even if they live to the age of 150, they're not going to run out of money. That's the focus it should be. That's the focus I want to see it. And when I see financial planning programs that forecast people drawing down on their principal so that they run out of principal at 99, that bothers me a great deal because a lot of people are going to live past 99. In fact, 43% of people who are now retired and are affluent will live past the age of 95. 43%. That means a number of them will live past 100. And if they're forecasting through financial plans that they're going to run out of money at 99, can you imagine going back to work at 100? Selling peanuts at the Mariners game at 102? Flipping burgers at McDonald's at the age of 105? Wait a minute, what's going on? No, I want my clients to be sure, if they live to age 150, that they're not going to run out of money. In fact, 180 or 190. They'll probably live longer than I do, but that's okay. We've got a way figured out so that even when I'm gone, there's a replacement. And finally, most of my clients don't want to leave anything to the U.S. government, even though we're pushing almost a $20 trillion debt. They would rather leave their funds to children or to charity. But the last choice for them is to leave their money to the U.S. government. You know, some of my clients are retired, and they've accumulated, they've saved, they've built businesses, they've worked hard, they've worked in their companies. They want to make sure that they have enough money to live the remainder of their life without running out of money. And how do they get there? That's the issue of where we are. In the next few months, it's going to be a time in which people evaluate their portfolios, and at the beginning of the year, people will sit down with their financial advisor and go over how they've done. They'll look at it, and they'll look and see, are they on track? If not, do they have to save more? Do they have to gain more? Those are times when financial advisors will sit down and look at the portfolios and sometimes make significant recommendations to change portfolios. You know, Jackson National Life did a survey back a few years ago in which they found that 75% of advisors feel they outperform the market. Outperform. 75%. You know, it's not a surprising number because if in a large group of people, 200 people, you ask how many people are better than average drivers, 75% of the people will raise their hands. That's an average. 75% of financial advisors believe they outperform the market, but Cerulli and Associates, a research firm, did look at the actual numbers and the performance for 2010, 2011, when the study was done. Standard & Poor's was up 17% for those 2 years. Financial advisors were up 4%, cumulative 4%, less than a quarter of what the Standard & Poor's. There's no way that 75% of advisors were outperforming the market. Now, we did a lot better, but those times come and go. 2016 is not one of those years. 2011, 2010 were. 2015, 2013, 2014, 2008, 2009. Those are all years better. We're coming to another break. Don't go away. So much to cover today and so little time. It's kind of life. So many things to do and so little time to do it. Don't go away. We'll be right back after this break.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com. KOL.
We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So, I've been talking about this time of what my clients expect and want. I think it's important as we go to the end of this year and we go to the beginning of next year, the clients really sit down and think about where they are and what they've seen, not just in this past year, but over the past few years. Where have the portfolios been and what's going on? We've had a very, very good market. Remember, in 2009, the market was at 6,600. Today, we're at 18,000, almost a tripling. If your portfolio is not up threefold, you have to ask the question, why? Why is it not there? Now, with all those things going on, one thing that happens is people sit down with their financial advisor and they've had a mutual fund that doesn't perform well, or several that don't perform well. And so they begin to switch and make changes. The difference is, I manage stock and bond portfolios so that I know the individual securities we hold and I can value those securities, even when they're down. And some do go down unjustly. Peter Lynch said if you can't be a buyer when you're down 25%, if you're not a buyer when you're down 25%, you're never going to have better than mediocre results. That means that very often stock prices fall unjustly, and you have to take that into account and know when to buy and when to sell. But when you're dealing with a mutual fund, you're dealing one step or two steps away. And so what happens is people begin to get into moving and switching things around. Dalbar does a study, and they've been doing this study for 30 years. They look at the average mutual fund investor, both those who are doing it themselves and those who are relying on financial advisors. And they look at how they stack up compared to the market. And their last study was for over 30 years. For 30 years, they looked at if a person started with $100,000, where would they be after 30 years? And what they found is if they invested in just stock mutual funds, the average investor would be at $286,002. Now that sounds pretty good. They'll have seen their money triple over 30 years. And a lot of people will look at that and feel pretty good about it. But if you look at how the market, the Standard & Poor's 500 has done during that time, that $100,000 wouldn't be $286,000. It'd be $2,122,469. That's the difference between 3.7%, which the average mutual fund investor achieved, and 11%, which was the Standard & Poor's 500. That's only 8% difference, 7.5% difference. 7.5% difference makes a difference of almost tenfold. tenfold. That's huge. Actually, it's closer to 7.5-fold, but you get the idea. 286,000 versus $2.1 million. And yet the idea is for most major firms and even some of the small firms, they're saying sell the relationship, not the performance. Sell the relationship. You want people to really like you. Yeah? Sure, they hired you, but they're willing to accept you. They're willing to keep you going because you want them to like you. Yeah, over 30 years, you've moved in and out, and you've made moves, and you're showing that you're doing things for their portfolio. But the average is 286,000 that you've grown that 100,000 for, and you look at that, and somebody shows you started with 100,000, now you've got 286,000. You feel pretty good about that. What you don't feel good about is if you knew that you should have $2.1 million. That's just doing market returns. If you do 1% per year better than that, you're talking about close to $3 million. Not 286, $3 million. That's what the average mutual fund investor gave up. You know, if you said to somebody, would you rather have 3 million or 300,000? People would say, I want 3 million, not 300,000. Are you willing to take the action to get you there? You know, all that's past. That's what happened in the past. That includes 2008, 2009. That's past. And what you've done in the past, you can't go back and undo. Investors can't go back and undo. You know, I would like to go back and undo some of the stock buys I made, but I can't do that. All I can do is go from this day forward. That's true of investors as well. It's true of you. You can't go back and change what you've done, but you can change what you do in the future. You don't have to accept mediocrity. You don't have to accept average. You don't have to accept below average. Even if you like somebody, you have to evaluate. Think about it. Managers and owners of baseball teams or football teams, they get to know some of their players. They like some of their players. But if they don't perform, what do? They get rid of them. Managers who don't win, they get rid of. So why should an investor be any different? If financial advisors don't perform over a long period of time, shouldn't they be gone? Now, I'm not talking over a short period of time. I'm talking about over a long period of time, over a 10-year time period. And it takes 10 years to do that, or 5 years, or whatever it might be. But if you go year after year after year, and if financial advisors are saying 4% is a good return, it's not a very good return. Believe me, 4% is not very good. There are a lot of publications that are coming out now. Research Associates is saying that 401ks, the best you can hope for is less than 5%. I don't believe that. And yet I believe that many, many people who are doing 401ks will accept 4%. Many people will listen to their financial advisor that 4% is good. Investment News came out with an article that was published a year and a half ago, where they had an author of an article that said, if you achieved any more than 5%, you were taking too much risk. I don't believe that. I don't believe that one bit. I think you need to take some risk and you need to be in the market. And there are going to be ups and downs. 2016 has not been the kindest year, but you know, it's been a long time. 2007 was the last tough year, 2007, 2008. But you go through those periods of time, and it's looking at the long term and the long-term results. You know, if you look at the 20th century, what did we go through? We went through a Great Depression. We went through numerous recessions, 1960s, 80s, the 1900s. Numerous recessions during the 20th century. We went through 2 world wars, World War I and World War II. We went through the Korean conflict. We went through Vietnam. We went through that whole thing with communism and the Cold War. We went through some significant events like Chernobyl, the meltdown. We went through a multitude of problems and unpredictable events. We went through assassinations, 2 assassinations. We went through all those events. We went through good presidents and bad presidents. You know what? With all those negatives, the Dow started at 66 on January 1st, 1900, and it finished December 31st, 1999 at 11,467. Think about that. All those negatives. The Dow started at 66 and it finished at 11,467. 66 to 11,467. Recessions, Great Depressions, World Wars, assassinations, problems, and yet 66 to 11,467. On a graph that starts in the lower left-hand corner and goes to the upper right-hand corner. And if you look at it from a long way away, it looks like it's a straight line up. If you look at it up close, sometimes it looks like a roller coaster. Sometimes it looks like a great deal of fear. You look at the 1930s, it was a time of great fear. You look at 61, when the market took a big drop, great fear. 87, the 90s, all those times, it looked like you were living on a roller coaster. Yet, if you look at it in the long term, 66 to 11,467. It's a perspective of having a long-term view rather than a short-term view. Listen to CNBC. Read some of the articles. It's talking and focusing on short-term events, short-term times. The idea is to be long-term. We're coming to another commercial break. Don't go away. We've got more to cover. It's been a day. We've got so much to do and so much to say. I'll be right back after this break.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and probably, most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019 or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
I've been talking about clients. I've been talking about client objectives. I've been talking about returns. 2016 is shaped up as a year in which the top 500 money managers, every one underperformed the market. That's pretty astonishing. I don't know that it's ever happened before. Ever. It's been one of those years, 2016. I did not expect it to begin that way. I didn't expect that it was going to be that way, but it has been. And yet, when you look back at previous times, and you know that I believe that history doesn't repeat, but that it rhymes. If you look back to the last secular bull market we had, 1982 to 2000, the market went from 1,000 in August of 1982 to over 10,000 in March of 2000. If you look at that period of time, there were really scary moments in that time too. Not like the 2008, 2009, but there were scary moments. 1987, when the market crashed one third in one day, just it went down 500 and some points. That was a terrifying time. Terrified a lot of people. A lot of people thought it was not going to end. I can remember I was new in the business. I'd been in the business just a year when that happened, a little over a year and a few months. And I can remember somebody came into the office, a mutual fund wholesaler, because they come in to pump their own mutual funds and tell you about how great they are. And he said $1 trillion was gone from the economy, that you'd be able to walk into Nordstrom and hear a pin drop that weekend. I went home, I said to my wife, we have to go to Nordstrom this weekend. This is what the guy said. You know, we went to Nordstrom and we could hardly get into the store. There were so many people there. I said to my wife, you know, most of these people must not know that $1 trillion has gone from the economy. It was a terrifying time. Now, he was just one of many people that talked about the terrifying times that were to come. You know what? We recovered from that. We went on. We had the recession in 91. We had a drop in 89, not as bad as in 87, the one-day drop, but we had a setback in 89. We had a setback in 91. We had a setback in 94. Those things happen during a secular bull market. And I've been talking for a number of years about the time in which we're living. Standard Chartered Bank. If you listen to the program, you know that I've talked about it. I'm going to continue to talk about it for a long time, probably, because I believe that it really underlies what we're going through right now. That we're seeing worldwide poverty being reduced significantly, people moving from subsistence to becoming middle class. By 2030, the expectation is that 93% of the world's middle class will live in emerging markets. And that underlies this whole Standard Chartered Bank study that we started a secular bull market in 2009, and it's going to continue probably to 2030. Doesn't mean we won't have down times, and we've had down times, but it means we're in a market where the emerging nations are beginning to become consumers, no longer subsistence, no longer at a poverty level, but they're really beginning to consume products, beginning to consume clothes, they're beginning to consume food, they're beginning to consume, whatever it might be. They're buying cars, they're making trips, they're beginning to move into that consumption side of the equation. No longer subsistence, no longer barely getting by, but really moving into the consumer side of the equation. That's going to continue to drive the worldwide economy at a higher rate than average. We saw that before from 1870 to 1913, driven by the industrialization of the United States. We saw it from 1945 to 1970, the rebuilding of Europe, and United States, the infrastructure, and all the things that were going on. And now we're going to see it because those people are buying our products. They're buying and consuming what we produce. That's going to continue. And for investors, it's important to be part of that whole growth period rather than shying away from it. We go through scary times, horrifying times, but in the long term, it's looking at the long term. I talked about the 20th century. A Dow that started at 66 and ended up at 11,467. Depressions, recessions, world wars, assassinations, and yet the Dow went from 66 to 11,467. We're living in a secular bull market. It doesn't mean we're not going to have recessions. It doesn't mean we're not going to have corrections. It doesn't mean we're not going to live with short-term bear markets. But the long term, the push is upward. We're seeing wages increase now. We're seeing low unemployment in the U.S. We're seeing the U.S. take advantage of a worldwide condition because commodity prices are low, but they're not going to be low for a long time. And for the first time, we're starting to see the kick up of inflation. You know, how will the bull market end? I talked about that. And very briefly, let me tell you what I think will be the end. Can't ever say. You never have a crystal ball. You can't be sure. But in my estimation, what's probably going to happen is commodity prices are going to begin to slowly increase. And it's going to be a time like we experienced in the 50s, the 60s, and the 70s. 1962 to 1964, inflation was running 1 to 1.3%. Kicked up to 3% in 66, was 3% in 67, 4% in 68, 5% in 69, 6% in 70, 4% in 71, 3.2 in 72. And then, of course, we got into the oil market and OPEC, and inflation took off. By 76, it was up to 6%. 75, it was 9. 77, up to 7%. And the late 70s and early 80s, it got into the double digits. I think we're going to see that again. That's how the bull market will end. It's a slow, it's a gradual thing. It's not going to be an overnight. It's not going to be a 2008, 2009 in all probability. It's going to be a time in which you barely see it happening. That, I believe, is probably beginning now. But it's going to take a number of years. It's going to take a decade to really build. It's a time to be prepared, but a time to benefit from the bull market until it really does end. 2016, one of those years, it's a tough year for many people. But those years come and those years go. It's a good time, if you're standing on the sideline, to get into the market and begin to benefit. You know, it's not enough to be average, in my opinion. It's not enough to be mediocre. It's important to be a winner. And that's the purpose of this program, is to put you ahead of the curve, to give you the information so that you truly can be a winner at this game. That wraps up today. We had a lot to cover. I will be back next Friday with another program. Have a great weekend, and I will be back to talk about money.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on AdamsFinancialConcepts.com. That's AdamsFinancialConcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com. The following program sponsored by